Hey everyone, welcome back to Corporate Decoder. Today, NMTC just filed an amended quarterly report, and I'm seeing one red flag that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is trying to clean up some accounting errors, but the underlying business struggles are still very much there. So NeuroOne Medical Technologies, or NMTC, had to file an amendment to their latest quarterly report. This means they originally filed something, but then found errors and had to correct it. The main reason for this correction is that they messed up how they recognized revenue and the cost of that revenue. They basically double counted some sales and expenses from early 2026. This is a big deal because it means their previous financial numbers were wrong. To break it down, the company found mistakes in how they recorded product revenue and the cost of that product revenue. This happened because of some complicated accounting rules, specifically ASC 606. The errors led to their revenue and profit being overstated by nearly $500,000. On top of that, their accounts receivable, which is money owed to them by customers, was also too high by over $500,000, and their inventory was understated. Management looked into this and decided these mistakes were big enough to be considered material, meaning they actually mattered to investors trying to understand the company's financial health. They said it was due to a mistake in tracking customer orders, not intentional wrongdoing. They are now putting in place better checks to avoid this in the future. But honestly, anytime a company has to restate its financials, it erodes confidence. It makes you wonder what else they might have missed or will miss. Let's dive into the numbers. By the 31st of March 2026, the company had about $2.8 million in cash. That sounds okay, but then look at their accounts receivable, almost $1.9 million. Normally you want to have good receivables, but here it's a significant chunk of their assets. Their inventory is also over $2 million. When you add everything up, their total assets were around $7.5 million. That might seem like a lot, but then you look at the other side of the balance sheet. Their total liabilities and equity were also around $7.5 million. What stands out is their accumulated deficit, which is basically all the losses they have ever had, minus any profits. That number is a staggering $82.4 million. This tells you they have been losing money for a very long time. Now let's look at how they are performing. For the first 3 months of 2026, their product revenue was about $1.86 million. That sounds okay, but then look at the cost of that revenue, which was $871,000. That leaves them with a gross profit of just under $1 million. That's a gross profit margin of around 53%, which is not terrible. But it's not like they're making a massive amount of money on each sale. But here is where it gets tough. Their operating expenses, which include selling, general, and administrative costs, plus research and development, were over $3.3 million. That means for just 3 months, they spent more than double what they made in gross profit. This resulted in an operating loss of nearly $2.4 million in just that one quarter. When all is said and done, their net loss for that quarter was also almost $2.4 million. For the first 6 months of 2026, the story is similar, just bigger numbers. They had a net loss of over $3.8 million. This is a consistent pattern of losing money. Looking at their equity, the total stockholders' equity at the end of March 2026 was just over $5 million. But remember that huge accumulated deficit of $82.4 million. This highlights how much money has been lost over time. It's like they've dug a massive hole and are only a tiny bit out of it with their current equity. When we look at how money is actually moving, their cash flow from operations for the first 6 months of 2026 was negative $4.4 million. This means they are burning through cash just to keep the lights on. They tried to get some cash by selling stock, bringing in about $757,000 from financing activities, but this cash burn is a serious concern. Overall, their cash position decreased by almost $3.8 million in just 6 months. They started with about $6.5 million and ended with $2.8 million. If this trend continues, they will run out of cash very quickly. Now, about that restatement, they are correcting errors in product revenue and cost of product revenue. The problem was with how they handled modified purchase orders. They ended up counting revenue and costs twice for some shipments. This is a pretty basic accounting error, and it definitely makes you question their internal controls. The restatement shows accounts receivable was overstated by $529,135. That is money they thought customers owed them but didn't. Inventory was understated by $232,782. This means they likely had more product on hand than they reported. These adjustments reduce their total assets and equity, which is never a good sign. This is probably the most important part for investors. The company openly states there is substantial doubt about the company's ability to continue as a going concern. This is corporate speak for they might go bankrupt. They have lost money for years, have a huge accumulated deficit, and even with their current cash, they only expect to have enough to fund operations through September 2026. This is just a few months away. Keep in mind, this is after they restated their financials. Their plan to survive is to use their current cash, get more money from sales, and crucially, raise more capital from investors. But they admit that raising this money is not entirely within their control. If they cannot get more funding, they might have to stop operating altogether. This is a warning sign that is hard to ignore. For comparison, companies like Bed Bath & Beyond or Rite Aid faced similar going concern warnings before their eventual struggles. For a company like this, it's a very precarious position. They also mentioned that their revenue recognition process involves significant management judgment. This is another red flag. When revenue recognition relies heavily on subjective estimates, it opens the door for accounting manipulation or errors like the ones they just had to correct. This section talks about how they recognize revenue. They identify promised goods or services, figure out if they are separate obligations, measure the price, and then recognize revenue when they deliver. It sounds standard, but again, the fact that they messed this up so badly is concerning. The company operates in just one segment, developing and selling products for neuromodulation. This simplifies things as there are no diverse business units to hide problems in. The entire company is focused on this one area. Looking at their expenses, general and administrative costs for the first 6 months of 2026 were $2.9 million. Their research and development costs were $2.8 million. Together, these operating expenses are huge compared to their revenue. For the first 3 months of 2026, their product revenue was $1.86 million, and for the 6 months, it was $4.75 million. This is their main source of income, but it is not growing fast enough to cover their costs. Selling, general, and administrative expenses were about $1.9 million for the first quarter of 2026 and $3.8 million for the first 6 months. These are substantial costs just to run the business. Research and development expenses were $1.46 million for the first quarter of 2026 and $2.85 million for the first 6 months. This is where a lot of their money goes, trying to create new products and improve existing ones. The bottom line is net loss. For the first 3 months of 2026, a net loss of $2.38 million. For the first 6 months, a net loss of $3.82 million. This consistent losing of money is the core problem. This section talks about their internal controls, or rather, the lack of them. They admit to material weaknesses in their financial reporting. This means their systems for tracking money and making sure the numbers are right are not good enough. They specifically mention a lack of segregation of duties, meaning too few people are handling too many financial tasks, increasing the risk of errors or fraud. This is directly related to the accounting errors they had to correct. They also mention ineffective controls over revenue recognition. This material weakness means it's quite possible that mistakes in their financial statements could go unnoticed. For investors, this is like flying blind. You cannot fully trust the numbers presented. They are in the process of fixing these issues, but as of the end of the reporting period, these weaknesses were still not fixed. In the risk factors section, they again point to their internal control problem. They say their failure to establish and maintain effective internal controls could lead to material misstatements in their financial statements and could hurt investor confidence. This is a pretty blunt warning. They also mention the risk of not being able to raise more money, which we already touched on with the going concern warning. So what is the takeaway here? N.M.T.C is a company struggling financially. They have a history of losses, a massive accumulated deficit, and are burning through cash fast. The recent restatement of their financials and their admission of material weaknesses in internal controls highlight serious governance issues. They are acknowledging they might not make it as a going concern, meaning bankruptcy is a real possibility. While they have some interesting technology, the path to profitability is unclear, and the risks are substantial. My biggest concern is their going concern warning combined with the material weaknesses. It suggests a company that is not only losing money, but also has fundamental problems in how it manages its finances and reports its results. The fact they had to restate their financials for simple revenue recognition errors is a serious red flag. I will be watching to see if they can secure further funding, but historically, many companies in this situation, especially with reverse stock splits and going concern warnings, face a rough road ahead. We often see declines of 50 to 80% or more from the share price in the aftermath of such events. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this analysis valuable, give it a like. Subscribe and join our Discord for more.